Hello and welcome to the big picture. The Governor of Reserve Bank of India has responded to the demands for cut in repo rate by bringing it down by 25 basis points this morning. This is the third cut in this year, bringing the repo rate from 8% at the end of last year to 7.25% now. Now that the RBI has responded to the demand, what next? How will this cut impact the various sectors of the economy? Where does the economy stand at present and what else needs to be done to kickstart it? With the GDP number at 7.5% and apparently the country the fastest growing in the world, overtaking even China, how will this decision of the RBI impact the economy? What are the factors which will have to be taken into consideration for the economy to revive, and how much does the onus now fall on the government and the finance ministry? A whole lot of questions need discussion and analysis. To do that, I have with me an eminent panel, Nitin Desai, senior economist who has held several key positions in the government as well as international organizations like the UN, Pinaki Chakraborty, professor at the National Institute for Public Finance and Policy, Mohan, Guruswamy, an economist and analyst, Renu, Kohli, former staff member RBI and IMF. Welcome to all of you. Mr. Desai, do you think that this rate cut was, because, it was said that the RBI governor will be looking at it closely, the inflation figures and all. He says today that still he is not very comfortable with the inflation situation, but still the 25 basis point cut, you think has been done under pressure of the government?
Oh, he had to do it. If he had not done this, I think he would have been in real trouble because of the quite explicit pressure from the government. And you can see from the reaction of the market that this is more or less what the market was expecting. Right. They didn't get more, so prices have fallen. Its impact, the economic survey had mentioned 800 odd stalled projects. Right. Well, with the associate who's an RTI activist, we got details on each one of those 800. The main reason is lack of demand and loss of promoter interest, right, not regulatory failure. Question I would pose is this going to lead to a revival of demand, particularly with the sort of stagnation we are going to get in rural demand, almost certainly this year? I doubt if it will, unless the banks really pass it on in a substantial way. But I don't think the banks can afford to pass it on. The
banks, the problem seems to be with the banks itself. And more, they're talking about infusion of funds into the public sector banks. But, the finance minister is talking some 8,000 crores. So this impact, this rate cut, how much of an impact will it have?
I personally think it will have very little impact because, this business of doing it in driblets, 0.25 at a time, doesn't convince anybody. I think he should have taken a plunge and done at least 0.5 this time, and to make an impact for people to feel the difference. Now, you're not feeling the difference. You've cut it down by 0.75 in the last 5-6 months, but each time is at 0.25. So you don't feel it. And I don't see how suddenly demand, people are going to start running and taking money from banks and investing it. It's not going to happen. And this focus on inflation, I think, is now a little misplaced. Because inflation is now, today I was just looking at the figures, has gone to the negative side. And whatever...
But he thinks that by January, it would have come down.
But whatever he does, whatever anybody does in this government and this kingdom, food prices are not going to come down. As long as there is a shortage of food, cereal prices you can control. You can control pulses. You can even control oil by importing. But you can't control the prices of vegetables, and that's what's going up. And
even the pulses have gone up quite a bit.
The daily basket of goods of consumption have also changed. Now, you can't control that. The farmer wants better prices, and he's getting better prices. And he's not going to watch your income go up and then sell you at 1965 prices. So this is a reality we've got to face.
So what are you trying to say? You're trying to say that the focus on inflation...
I think the focus on inflation is a little excessive now. A little bit of inflation actually helps the economy along. Because if prices are going up, there's an incentive to invest more, the incentive to produce more, all that. You take away all that. You say suddenly you got this minus, and then you got all this goods coming in from abroad, Chinese steel coming in and cement from somewhere else coming in, and prices are going to crash further. There's a commodities crash all over the world.
Okay. Would you agree with that, sir?
I would say that I would tend to agree with that. The reason is this is not attacking the core of the problem of demand. One, the companies had a good time because of the rural demand growth with high MRPs and Nikam money. That has stopped for 2 years. And this year, it's going to be even worse because of that. Second, capex demand. I don't see a revival of investment as yet, which means the capex companies are still not out of the woods. Third, the export-oriented fellows. With what is happening in Europe, etc., there is no export demand growth. We have a serious problem of demand growth. This is why I agree with Mohan. Stop worrying about inflation, worry about growth, demand growth. Because without that, you cannot get this economy moving, you cannot get the jobs, you can, etc.
Yes, the figures are coming in from rural areas, are pouring in. Tractor sales have been down by 1 lakh, from 6.5 lakhs to 5.5 lakhs. Motorbikes, which are bellwether of rural economy, is down to 2.6%. Everything is going down. And these people should wake up. Because, you got to stimulate demand.
We will come to that. We'll come to that now, who should wake up and how they should wake up. Renu, Kohli, how do you look at this? 0.25% is too less, too little, too less.
Yes, I agree with the other panelists that it is too less. And I think my reasons are simply that the extent, or rather the depth of the slowdown is very, very deep. And it's coming from a large mammoth debt overhang. There is balance sheet distress of firms and banks. And when you have this kind of slowdown, it takes much longer to repair. And that's where the lack of demand is coming from. We've also had very contractionary monetary and fiscal policies, and this is the third consecutive year in the running. And there is severe demand compression. So, when there is such a long distance between the extent of the slowdown, and you can see it in the, very low levels of capacity utilization, and the shocking drop in demand for power from the industry, that tells you the extent of the slowdown. So 75 BPS is not going to lift spending much, whether on the consumption side or on the investment side. And then, because banks are distressed too, so, as a couple of other panelists pointed out, it remains to be seen how much is passed on. The other thing I want to qualify is the how this has been received by the markets. My take on that is slightly different, because if you look at what the Reserve Bank has done, it has actually revised up its inflation projections. So as against in April, it was expecting 5.8%. By January 2016, it now expects it at 6%. Similarly, it has revised down the GDP forecast.
No, that's exactly the point. Sorry,
the Reserve Bank has brought in a new.
Sorry, Renu. No, that's exactly the point. Some critics say that when the RBI itself has the inflation in 2016, they're looking at 6%. It's higher than what they expected. Then why did they go in? There are people asking, then why did they go in for the rate cut itself?
Well, they have qualified it by saying that very carefully the rationale of their stance is, and I'm not defending and I'm not saying right or wrong out here, but they have preferred to front load the cut, which means simply that they do not want to discourage a supply response, which the RBI argues is essential for achieving the end point of their inflation objective, which is 4% by January 2018. And that's what I said. I think that's what the markets, what has spooked markets, which is that now a new goalpost is on the horizon, which is 4% inflation. So how much of growth sacrifice is there over the medium term is the question for, I would say, policymakers, that is particularly the government, to grapple with.
Okay. Pinaki, it's very interesting. And on the one hand, we are being told that, we are the fastest growing economy in the world, 7.5% GDP growth rate and all. And all that we hear is, pretty gloomy picture. Why is that happening? Why is this mismatch?
I think there are a couple of issues. I will definitely endorse the view that there is a shortage of demand, and that is reflected now because we had, as Renu mentioned, there was a contractionary policy stance that was followed in the last couple of years because we are excessively concerned about inflation, and we are also very concerned about the high level of fiscal deficit of the union government. And if you look at, despite talking about fiscal profligacy, actually the centre's fiscal deficit is progressively coming down from 2012-13 onwards, and the government has stuck to this number, whichever they have given. Of course, it's not 3, it is above 3, but they have maintained at that level which they have committed to the parliament. Now, at the same time, there has been significant increase in the interest rate till 2013, mid-2013, because of the high inflationary tendencies that we had. In that context, these 3 reductions that we had of 0.25 basis point is too little. And probably the time was, it should have been done little earlier than today to revive growth. Now, the second fundamental question is also, we are taking that if there is a reduction in the rate, immediately that would result in higher investment. No, because investment depends on multiple other factors, and one factor is investment, and there are other issues, regulatory issues, and there are other infrastructural issues, and there are various other transaction cost related issues. So in that context, I definitely feel this is only one step. Whether this would automatically lead to a revival of demand and investment is something which is very difficult to say. At the same time, if we look at both fiscal and monetary policy in conjunction, you will see that yesterday there was an increase in the service tax rate from 12.36 to 14%. So that also tends towards some bit of contraction, because government is trying to mobilize more revenues. So what do we see? So we have a projected GDP growth rate which is much higher at 7.5. We are trying to have a contraction in the fiscal policy through increase in the tax rate. Service sector gives a huge, because service sector contributes almost more than 50% of the total GDP, and at the same time we are also seeing there is a scope for a stimulus kind of a thing. By reducing the rate, you are trying to push up investment. So now how these conflicting objectives will play out and result in ultimately higher growth and development, we really do not know. And these conflicting signals are coming out in various forms. So when you look at, I think there is a major issue of coordination between fiscal and monetary policy, which was earlier also there. I think it still exists.
Okay. We are now joined in by Gopal Krishna Agarwal. Gopal Krishna Agarwal is the National Executive Member of the BJP. Mr. Agarwal, this conflicting signals. Now, it is said that whatever the RBI governor had to do, he has done. He has brought down the rate by another 25 basis points. Now it's up to the government to really take up the baton and carry it forward. What do you think the government will be doing now to revive the economy?
Actually, this is the way market has reacted to what the RBI policy is. That shows that there is a big dilemma. Situation is quite complex at the present. Because till now the economic roadmap was very clear. We had to do fiscal consolidation and control inflation. Now the real test of the government will be how to generate demand, because basically simply reducing interest rate and creating liquidity in the system will not is not picking up the investment from the private sector. The motivator for the private sector is the demand in the market, and creating demand in the market is an inflationary process, and controlling through this interest rate is counterproductive. So this dichotomy is seen today in the market, and the RBI, and they have given that monsoon will be predicted. Because of monsoon there will be inflationary pressures. They have to, at the one point of time, they have to control inflation through keeping the interest rate higher, but then at the same time they have to create demand and generate investment climate for economic development. Therefore, it was required that they reduce the interest rate. So this balancing is seen in the government policy and the RBI. This balancing has to be done, which is now a quite difficult thing, which we have to move ahead. But this will be the real test how economic growth grows from here.
Okay, that's interesting, Mr. Desai. The onus so is now on the government, and the RBI governor today, very interestingly, when he was asked about a question, he said that RBI is not a cheerleader. There are other people in the economy who can play the role of cheerleader, and he's clearly saying that now it's up to the government. Now, what do you think the government should do? Because one of the biggest things, as all of you have pointed out, demand is the
There's only one thing, which is they have to increase public investment.
That's correct. So public investment, from where will they get public?
Well, the fact is that they will have to look at the numbers, but even if it runs at the risk of running a slightly larger deficit, I would say without raising public investment, you will not get private corporate sector moving still. I think we should also see what the states can do. But the states are going to get a bit of a bonanza from the various things
the financial revolution.
Well, financial revolution is overstated because basically, if you take into account the reduction in the flow on the centrally sponsored, it's a few percentage points. But the money which will come to the eastern states from the coal auction and the mining thing is substantial. I hope that somebody is working and ensuring that that does not get frittered away into some vague schemes here and there. But because the states do invest. A larger proportion of the planned expenditure of states goes into real investment.
That is what about half a dozen states in this country have that capacity. What about other states?
Yes.
Poorer states, really.
The poorer states.
And that's a big difference.
But it will be a demand boost initially for the capex sector. And once you get the capex sector, the capital equipment sector moving, a lot of other things will also play. We will have to recognize the fact that on consumer goods, because of what is happening in rural India, it will be a difficult year.
Why is rural India facing this kind of a situation?
Because
after nearly 8-10 years of high rural growth.
Because for a couple of years you haven't had increases in MRP. The earlier growth was phenomenal increases in MRP. Second, the sort of money that was being pumped in through Bharat Nirman, Narega, etc., has stagnated and perhaps even come down in certain cases. Third, you had a fairly poor crop year, and there's a prospect of it getting even worse.
Yes.
So, and you can see these numbers, as Mohan was telling us. Tractor demand is down.
Right.
I saw headline today, car demand is down, motorcycle demand is down. So I'd say that we will have to live with. But the way I would do it is try and boost capital expenditures by the central and state governments. That will at least kickstart.
8,000 crores is what Mohan, it has been kept aside for investing in the public sector banks and things like that. But public sector banks themselves are facing huge bad debt problem.
Yeah.
8,000 crores is not even a flea bite to kind of hold the iron. 6 lakh crores as NPAs.
Right.
They need substantial recapitalization. That's neither here nor there.
No, in fact, the RBI governor is also talking of recapitalization.
Yeah,
Others are also talking.
But what Nitin says is right. You need to kick off capital expenditure. Public expenditure investment has to increase. Government has shown no inclination, no idea of doing this. Probably they don't know how to do it. But this is where you have to get your brains working and see where you can cut, where you can get more money and put it. Prime Minister is going from place to place, trying to country to country seeking investment, which is a good idea. But you got to make changes also here to show that you're doing something. You're not expecting overseas money to come and take care of the slack here. There is so much of slack. Like today, government is considering now very seriously of giving Air India 2,300 crores more. And like this, one rank, one pension. All kinds of things are coming. They're facing numerous pressures for more money to be allotted to different. At the cost of something else. When you give away some money, it's at somebody else's cost. The cost is, if you don't do public investment and, step up capital expenditure, you won't create jobs for people. There'll be a lot more jobless people, a lot more hungry people. You won't tackle those problems. And they have to get their act together.
Yes, one thing I would say what Renu was mentioning. The balance sheets of the private corporate sector are in bad shape, particularly the infrastructure companies. I think this is where some concept of securitization of the investments which have been made in roads, sports, etc., so that their balance sheet can improve, so that it is not as stressed as it is now. If that could be looked at, then I think that also...
What stops anyone from looking at it?
At the moment, we do not have a good market for securitization of completed projects.
Okay.
We do not have that. But it's a hope that with the sort of initiatives announced in the budget of the National Investment Fund, etc., something will happen. Because there are two things, demand growth and slightly healthier balance sheets. And Renu Kohli is absolutely right.
Both are related, I suppose.
To some extent. But the balance sheet problem is because of the very peculiar way in which we did PPP in infrastructure. which led to over-leveraged private sector companies who had bid extraordinary sums for things which were not going to show return quickly.
Okay, Mr. Agarwal, you want to come in?
Here I want to come in because now we will know that why our government was pushing some of the important legislations which will boost the economic development, because land acquisition, why we were pushing for is that we have to build rural infrastructure. That was required, and agriculture sector needed infrastructure. Second thing, GST is very important. These bills are very important and they are the backbone of future economic development. Further, even FDI also, we are the PM is going around and opening insurance, defense sector. So this will create the investment climate and ease of doing business that was required. And today there is a good report in the morning papers where the government will not look into only controlling fiscal deficit, but will look for investment, because now our focus will shift from fiscal consolidation to investment and creating demand, and government sector is the major demand creator for the economy.
Yes.
So this focus we are shifting now.
Okay. Yeah.
I think I should caveat it here, because these two things, these two reforms, which Mr. Agarwal, and GST and land acquisition, which Mr. Agarwal says are important. But they have a responsibility. They opposed it tooth and nail for 5 years. And suddenly you turn around, so you have an explanation to give as to why did you oppose it. Please go to the Congress party and say, we are sorry, we made a mistake. Now give us your support. You don't have the humility for that.
I have a different view on it.
I'll just come in, because we did not oppose land acquisition. We supported this. Some of the issues that came on the way.
That's okay. Mr. Agarwal, I don't think you need to give an explanation.
Incidentally, of the 800 stalled projects, only 66 reported that they were stalled because of land acquisition.
That's right.
No, but environmental clearance.
There was also environment
clearance was not mentioned. Look at the economic survey. Now, I'm not my numbers. No. The economic survey numbers, and I got the details for the 800. It's absolute. You talk to anybody in the corporate sector, they're holding back because they do not see prospects of profitable investment as well.
So it's a question of demand.
Yes.
Demand major. And their own balance sheets being stressed.
I know this false euphoria that I'm growing at 7.5% by tweaking the GDP figures. And then you think that you're doing wonderful.
You're doing wonderful, and that's exactly what I was asking.
It's like sitting in a train with shutters down here.
Renu, now the ball is in the government's court. Nothing much more can we expect from the RBI for the next several months at least.
Yes, I think the ball is in policymakers' hands, because in the immediate short term, whatever structural reforms are to take place, ranging from GST to anything else, we must not forget that structural reforms do take time to translate into growth outcomes, and that is a medium-term thing. So the question of revival right now is a short-term cyclical recovery, and to recover that, how much policy space is there? Now, from the Reserve Bank's admission and growth outlook as well as inflation outlook, it sort of became very clear in a sense that there isn't much more monetary space left, unless, of course, inflation surprises considerably on the downside. Now, that sets the ball into the court of fiscal policy, and that is in the government's hands. So let's examine how much of fiscal space does the government have? Not very much.
How much does it have?
It does have, and it can, and it is reviving capital expenditure and so on. But you see, if you have a 1.8 trillion, nearly a 2 trillion economy, rupees economy, that's the base, how much of boost can it give? How much can it lift spending? How much can it lift growth? So I would say that given the, very reduced or diminished appetite, weak investment appetite of firms, remember that, firms will think of investing only after their balance sheets are repaired and they see revenues on the horizon. Right now, they are not at that state. They are still at the state wherein they're grappling with bad debts.
Okay.
So,
yes, Pinaki.
I would say that...
okay. Yeah.
I would just like to comment two things on the fiscal space issue. I think budget has just been passed. It's 2 months that the government has, February, March, April, May, 3 months that the budget is. Now, if we look at the spending pattern of the central government, significantly the capital expenditure has come down over the years. This is the first budget, maybe after 10 years, you see there has been at least budgetary allocation in terms of GDP, the capital expenditure has gone up. The reason being that government was spending on sectors which are primarily on state list and concurrent list subject. Government was spending on rural employment, government was spending on health, government was spending on education, but the union government was not spending where it should be spending, like big infrastructure, better coordination among states. I think those issues were neglected and states were growing in silos. I think that needs to be tackled. And if we look at this year's budget, if we talk about fiscal space, despite sticking to the fiscal deficit target of 3.9 as was predicted, as was made in 2015-16 budget, and 14-15 for 4.1%. This year's budget shows there has been an increase in the capital expenditure. Central plan outlay for capital expenditure has gone up. So there is a structural change that is visible in this year's budget, but whether ultimately the revised number and the actual number will translate into that or it will go into populist scheme, we really do not know. And also, I think when we talk about GST, it is very important to understand that GST is not a center versus state issue. It's a center and state issue.
Absolutely.
And center and states should come together. There should not be a politically vertical divide between states and the center and then or among the states. And that is holding GST back. And if that happens, that would be very unfortunate.
That seems to be operating. Mr. Desai, very quickly, we're running out of time. You know, what Pinaki spoke about. Is there an ideological issue involved here now? He was talking about in the last 10 years, the kind of investments were being made more in the rural sector, the neglect of the infrastructure sectors and that. So will we see an opposite of what had happened?
I'm afraid of last few months, my impression is that here also populist pressures are increasing.
Right.
And there is a focus, I think Mohan referred to one or two things, that focus will continue to increase. I think basically we need this boost, but ultimately growth in India is going to come mainly from the private sector, investment growth. And we have to recognize that. And I think we have to address the question of what is it that is holding our own people back. We are going out
They are going and investing outside.
They're investing outside, and we are asking outsiders to come here. Now the outsider will ask, why should I come there when your own fellows are not going investing?
Absolutely.
So I'd say that they must address this issue. The 2004-2010 growth was very much due to a tremendous increase in corporate savings and corporate investment, virtually doubled as a proportion of GDP. And that has gone. Our savings rate is down, Pinaki can correct me, is down to around 30%.
Yes. 30.
Something like that. And it is a huge drop. So I'd say that this is what I would look for.
Mohan, I want you to foresee now in the next few months, next year at least, what are the stumbling blocks which the government can face despite its best attempts and best intentions?
No. First of all, the government must sit down and agree that there is a problem. I have a feeling that they are not aware there is a problem because you start generating these figures and you start live in this make-believe world. Then you start believing what you are saying outside. So day in and day out, they're all talking about great growth figures, great demand and power, forget about all that. Deal with reality. If they deal with reality, they'll know what to do. Because the solutions are very simple. Nitin said capital expenditure has to go up. You got to stimulate demand. Solutions are very clear. And there is money available in the system where you can pull out and push it there. But you got to then first analyze the problem and say, this is the problem.
Okay, very quickly, Mr. Agarwal.
I just want to say that when I started, I said that now is the real test of the government because that is the problem. That means we are realizing that fiscal consolidation was only one part of the economic development. Now is the real test where we have to create demand through investment. Okay. Second thing I just want to mention is that we should remove our focus on controlling inflation only through RBI. We have to do food management through market. Integrated. That is also important for inflation.
I'm sure the RBI governor will agree with you what you said, not putting the entire onus on him. Anyway, it has been a very interesting discussion. We'll wait and watch how the government will respond to these challenges which it faces. Thanks to all my guests. Please keep watching. We'll come back with another issue, the big picture, same time tomorrow.